Tough macroeconomic situations along with geopolitical risks pretty much control the narrative for 2022. But will budget give the required booster shot to the market, especially ahead of elections 2024? Let's find the answer. Hi there, I'm Nikki. Along with me is the senior editor, N. Mahalakshmi, and we're in conversation with the founder of IIFL, Mr. Nirmal Jain. Mr.
Thank
Jain,
you.
thank you
Nikki.
so
Thank
much
you very
for taking out the time and speaking to Moneycontrol.
My pleasure.
First, let me start with where the markets are today. Last few days, if you see, markets seem to be slightly in a VP mode, despite the fact that yesterday we had very positive numbers on inflation front, on IIP and all of that. Even the global cues were not really negative. Still, markets seem to be sulking. What do you think is the reason? Are we factoring in some negative news from the budget?
No, I think market currently is correcting for different reasons. One is that Indian markets had outperformed the other peers by a huge margin. So valuations have become a little higher than long-term averages. Obviously, there's a reason to correct. Also, what has happened is, to many investors' surprise, China has opened up with a very aggressive stance. So, earlier they had a very conservative zero COVID policy, and there was a huge lockdown and disruption. But I think they've gone to the other extreme, and the Chinese stock had corrected significantly. So in terms of value, or in terms of relative valuations, obviously Chinese stocks are much cheaper, having underperformed for a reasonable time period. So the trade that is happening by FIs is that they are just trying to rebalance their weight of the emerging market portfolio. So they are selling Indian stocks and they are buying Chinese stock because they are much cheaper. And I think the first week, $1 billion of Indian stocks have been sold by FIIs or FPIs, and obviously money is flowing from India to China to rebalance the portfolio, and these foreign portfolio investors selling has triggered the correction in the market. But in a way, correction is healthy because markets were at a very high altitude, so they needed a correction and they got a correction. I don't think this has anything to do with budget expectations.
Sure. What is the market expectation at all with respect to the budget?
I think India is in a very good sweet spot in the world, which is hit by inflation as well as fear of recession. So market would expect that manufacture in India, theme which our Prime Minister Modi ji had initiated and now is gathering momentum, will get further impetus in this budget. Great opportunity for India for the first time. I mean, there have been lots of talks about India being alternative, but that was never feasible. But now most of the global companies that outsource, they're very serious about making an alternative to China. And in terms of scale, in most of the manufactured products, China is way ahead. And therefore, even the slight increase also would be a significant delta for many manufacturing sectors. So I think one will be to continue the growth or to accelerate the growth in manufacturing with the PLI scheme and all those, whatever momentum has come. I think government will try and see that is carried forward. Also, I think there'll be the election is 1 year ahead, and inflation has impacted the rural India as well as poor people in urban India. Therefore, budget will try to do something so that the real income is maintained. So might give them some incentives, some benefits to farmers as well as poor people. I mean, that is something which is typically every government tries to do as a populist thing, but here I think there are more compulsions because of the inflationary impact that the lower income strata of population, whether it's agriculture or industrial, would have had. So I think that is the second thing that we'll see. Another thing, I think there'll be a huge focus on capex and investment. Because investment cycle and private sector capex also is showing signs of revival after a very long time. So government would try to incentivize that. And capex cycle revival and growth is very important to maintain the economic growth. So I have a feeling that there'll be good incentives and a investment layout for those capex plans as well.
So I'll ask you a question related to capex plan a little later, but what is your own expectation on growth? Right now, everybody seems to range around, expectations seem to range around 6 to 7%. Is that what you would think?
I would be rather bet on the higher side of the range that people are expecting. 6.5 to 7% is something which is feasible for India. And given that there's the investment flow, savings, as well as monsoon has been fairly good. I think it'll be closer to 7% growth this year, the GDP growth.
And where do you see, I mean, what pockets do you think will drive this?
Yeah, so capex, capital goods engineering sector will also be a contributor. I mean, they have not been a contributor for a long time. Agriculture will be again healthy growth, and services will continue to grow as it has. So it will be overall growth this year. So I don't think there is another good feature about current growth pattern is that it's fairly balanced.
So when you talk about capital expenditure, are you saying public expenditure, or do you see private expenditure picking up or private capex picking up over the next 12 months?
I think the layout or the outlay for public expenditure will also go up, and there'll be incentives to make sure that the private sector capex also goes up significantly higher from what it is now. Private sector capex will be driven by the demand and the capacity utilization, and government will try and make sure that the tax and other incentives are in place to make the impact of private sector capex on the interest rate increase has to be negated by fiscal measures. So I think government will try and make sure that fiscal incentives are there for the private sector capex. And a conducive environment in terms of tax stability, policy stability is also provided to private sector.
Will that really trigger it? Because today, if you talk to corporates, the two things that really hold back private capex is this global uncertainty, and the second thing is that capacity utilizations are still for most industries around 70%. So unless demand, you see sustained growth in demand or demand galloping, is there really a reason for capex to happen over the next 12 to 18 months?
Background is better.
So private sector capex, again, because there are different sectors and every sector has a different equation in terms of capacity utilization. Also, many sectors are seeing a good demand from exports as they become alternative to China, or even now there are alternatives to some companies in Europe which are either shut down or not doing too well. And Europe has been hit very badly by the energy crisis. So energy intensive industries will again see significantly higher increase in exports. Also, the demand which is from defense and the public sector spending will also trigger higher demand for the private sector. And that cascading impact will also drive. And see, the capacity, new capacity for last so many years has been very low.
Yeah.
And therefore, whether the capacity utilization is 70, 80, 85 or 60 depends on industry to industry.
Right.
But on the whole, there are many pockets, many industries where new capacity is now being planned by many industrial houses.
Okay, so you are hopeful over the next 12 months private capex will pick up.
Private sector capex is picking up.
And this, for the past a few weeks, credit growth is about 18%. Do you see that going up?
I think that is already healthy, and this 18% is also a bit pent up also, and revival in the demand. I think it will maintain in this range. I don't see that jumping significantly because already at a reasonably healthy and high level.
Right.
So I think the credit demand will be in this range.
I would want to chat a little bit about the corporate earnings growth for the year, right? 15-17% is what the consensus is. What do you think would be the trigger point to this kind of earning growth, and which are the pockets you think that will make the earning growth come through for the markets?
I think this is the kind of earning growth which is feasible for Indian market. Given the trigger point is obviously the demand revival and the inflation.
Right.
The prices have also recovered. And most of the companies during the difficult time period have become cost conscious, and they cut down on their cost, improved efficiency. Technology is also improving efficiency in many sectors. Services sector becoming more dominant where margins are higher. And all these things put together, there are some sectors that might still deal under some sort of a pressure, but on the whole, 16 to 17% earning growth is quite likely. We should not forget that the earning growth has also been slow in the previous 4-5 years. So on that base, which is say kind of lower base, the growth can now pick up.
But this year's base is not particularly low, isn't it? Because you also had inflation this year. So the nominal numbers are already exaggerated. So taking into account FY23 numbers, going into FY24 may have a moderating effect, isn't it?
So for India, I would say 16 to 17% is moderate growth. given that if the GDP grows by 7% and inflation is say 5 to 6%, then your nominal income is growing by say 13%. On the 13% nominal income growth, also GST and all these factors have led to formalization of the economy.
Right.
So most of the listed companies are part of the formal economy. They're also seeing some shift from informal to formal sectors, and that's why I think 16-17% growth is
Possible.
the top line grows at that level, and even at 12 to 13 or 14% the top line, which is in line with the economic growth in nominal terms, some margin improvement can
Peg it at 16-17%.
make it at 16-17% can be delivered.
Sure. So we know economy and stock markets are two different animals. So purely from a stock market perspective, and you also alluded to the fact that money is now moving to China because there is pickup there. So allocations that were probably coming to India not last year, but at least the previous year will now start to get diverted to China. Will that have a negative impact? How do you see that panning out?
So I think there are two factors here. One is that the domestic investment, the domestic savings have become a much more powerful force now. So this sporadic selling of FIs can have a temporary impact, but otherwise the underlying current is still very bullish because the domestic money flow into stocks and mutual fund is still very, very strong. In last 5 years more so, but this has been the trend over last several years, that the impact or the vulnerability to flow of foreign portfolio investors' money has reduced significantly. And because India is a large country, it's $2.5-3 trillion economy, and savings at whatever rate we have is a very significant amount compared to the money that foreign investors have been investing in portfolio by portfolio route. So that is one thing, that the medium to long term domestic money will rule the roost, and that's the key one thing. Two, even the flow of money from India to China in terms of the allocation of some of the foreign investors is a temporary phenomenon, because fundamentally India is still a good story and a long-term story. Just as most of the MNCs are looking at alternate sourcing base, many investors now also, they know that they can't be over-dependent on China. China is volatile and vulnerable. So I think if price correction can happen in a week or two or few weeks, and then obviously the allocation can shift back or can get back to the normalcy. So the reallocation process where this is being sold to buy that will not last too long.
Sure.
And then markets will stabilize and see a good recovery, or at least a healthy trend over a period of time.
Sure. So for this calendar, what would be your expectation? Can we do about 15% plus kind of return?
I think, yeah.
It's not in the nature of markets to do 10-15%, although we keep saying that, markets.
For last few years, it has not done. And most of the time, market tends to discount the next 2-3 years good earnings also.
Correct.
So, but this year, I think 50% return is quite feasible, because many sectors like capital goods, construction, they never participated consistently, but now the outlook has improved. And also the China recovery or the China opening up augurs well for metals and commodities. So they will also see earning growth significantly higher than what people would have earlier thought. All these factors put together, I think 15% earnings growth and the similar kind of rise in stock market indices is quite feasible.
Fair enough. And what are the risks you see on the horizon, if you were to sort of say top 3 risks for stock markets this year?
So for stock market, I think one risk is geopolitical, because from Russia, Ukraine to India, China, there are many sort of situations which can suddenly become very volatile and very tense, whether it's a Taiwan or China, Taiwan, India, China, Ukraine. So, and what we saw in 2022 is that world again is becoming a very risky place in terms of peace and stability. So that is one. Two, the recession in the US, which is now people are thinking will be mild or not there. But most of the analysts and economists think that Europe will go into recession.
Right.
US will just survive or maybe at the edge. Now, if that becomes a little worse than what people expect, then obviously there will be an impact globally. And right now expectations are that because inflation is coming under control, US rate increase will slow down But if they become aggressive, then obviously there will be an impact on currency.
Sure.
And that can have an impact on our economy and markets as well. So I think the geopolitical risk, the risk of recession being much worse than in the US or maybe in Europe also, if it's significantly worse than what people have already factored in, it will have a ripple impact on the rest of the world as well. And that apart, locally I think mostly people expect stability, but and one has to see how the budget is. But if it tends to be very populist, and if there are some political developments which are a little uncertain, then the policy stability and reforms what people have been used to, if that gets derailed or disturbed, then also there will be impact on the market sentiment.
What are those?
Also, I would say the government will have to achieve their disinvestment target this year because although the tax buoyancy has been very encouraging,
Yeah.
but if you still want to increase your capex and investment significantly, then you have to rely on the and also at the same time you want to increase your outlay for the farmers and the poor people. Obviously, government will have to make sure that the disinvestment targets are achieved, and they get significant amount of money from there, so that the fiscal deficit remains under control, which in turn is important for interest and inflation rate.
Is that not a tough ask going into elections? We have 1.5 years away from elections, and the track record of disinvestment so far has not been really encouraging. So would you expect that going into the last year?
This time I think there's a lot more political stability, and the government should not be under any compulsion to take populist measures beyond the reasonable limits, primarily because there does not seem to be any serious threat, or it's not that the inflation has been so bad. See what happens that most of the countries when there's a huge unemployment or inflation is really bad and poor people are very badly affected, that's the time governments are pressurized or compelled to take some extreme populist measures. But that is not the situation in India today. So things are fairly stable. Inflation also, you have seen today that numbers are coming down. So I mean, the government can stay the course on the reforms and a pragmatic, stable policy environment.
Sure.
Actually, you just stay on budget for now and just ask probably more questions related to budget. We wanted to understand what is the big theme coming in according to you in this budget. Would it be more focused towards infra? Would it be more focused towards the theme overall in this budget? What will that be? You think it's going to be more focused towards the rural? It's more going to be with the infra? Or you think job creation, social welfare? It's coming ahead of elections, right? Any big bang reforms you expect?
I don't expect any big bang changes because stability is very important.
Right.
But I think if you ask me theme or focus, it might be on the capex and investment.
Right.
Because I think that is what will lay the base for sustained growth over a period of time.
Right.
And capex in the last few years have really lagged the target. So I think there will be a focus on infra and capex this year.
Okay. And also, how much of fiscal consolidation is likely, you think, in FY24? It's quite a macro, but and how will the markets digest if the number is untowards to what the expectation is or as per what the consensus is here?
I think the way the tax collection has increased and disinvestment assets are there, but the market probably has not helped in the last 2-3 years, but now it's more favorable. So fiscal government will remain in the range that is prudent. I don't think that any fiscal slippages of significant amount would be expected.
Sure. So what's your number? You think they will be able to achieve 5.8, 5.9?
So 5.5 to 6 is the number that will continue for next 2 years.
So if at all there is a slippage from that, because 5.8, 5.9 is probably the expectation. If we don't do that, do you think the markets will react to that, or will they take it in their stride, saying that this is a budget for growth and therefore we can sidestep?
That's a good question, but it's very difficult to say because it depends many times on how the environment globally is.
Right.
So if India is in favor for other regions, then market can take this in stride. minor variations will not make much difference to the investors. It may make newspaper headline and 1 or 2 day impact, but long-term investors understand that okay, 5.8 or 5.9 is not going to kill their investment. So I think first of all, this will not become 7,
Yeah.
and therefore in the narrow range it will not have much impact.
So, what will delight the market, if at all, in terms of expectation, whatever is built in? What do you think can delight the markets, and what would really disappoint?
So what will delight the market in the short term, maybe a little different from the medium term and long term. In the short term, if there's a rationalization of capital gains tax or some reduction there, might be a good, for a technical market can be a good point. From medium to long term market will look at the fiscal discipline, investment which will sustain the growth, and consistency of policies, and how pragmatic policies are on make in India and to incentivize the manufacturing. That in turn will create jobs. So I think markets will look at that.
Fair enough.
So what can be dangerous is the reversal of the say increase in capital gains tax or estate duty or these kind of things can be a little disturbing for the market.
Are you expecting any kind of changes in LTCG, or for that matter, a rationalization of durations or across asset? Most of the conversation these days is around is probably, you have to align the rationalization in a way where, the duration is just aligned to all the asset classes. You think any of that would be doable?
I think right now it's become very complicated because the long-term capital gain tax on listed, unlisted, debenture, real estate, everything has become very different for companies, for individuals. So there will be some rationalization here.
Right.
But it will not be negative. It will not be something which will really increase the tax rate impact on most of the people.
So one thing that is very evident in the data is that deposit growth for banks is lagging behind credit growth, and there is a huge gap. And obviously that is a pain point at a time when you want more credit to grow more, you want to spur private investments. Do you think this is a serious consideration that could drive a decision in this budget?
So I think there is something which banks have to do it, because what had happened in the last few years and last 1 year, credit interest rates have gone up. So banks have really not matched the interest increase in the deposit because they thought that's coming easily, and whatever credit growth is also not very strong, so we can maintain it. So obviously people look for alternatives, and once the deposit interest rate goes up, the deposit growth will come back. So banks will have to bear this because they can't allow, they can't say that okay, our margins will go up by the interest rate increase, but we don't want our cost to increase. So obviously there is a chain effect, and many banks have already taken note of it, and they started increasing the rates, including the largest banks.
Right.
So we'll see deposit growth might come back a little bit. Also, deposit again is savings. So when people see other instruments like bonds or equities giving much higher return, they tend to move money there. But long story short is that banks have to increase the interest rate, and deposit growth will revive to a good extent.
The flip side to that question is, does it create a downside for equities? Because again, looking at the earnings yield and bond yield or deposit yields right now, does that become favorable towards fixed income?
So that becomes favorable to fixed income for sure. But in India, the difference in the return expectation is so significant that a minor change won't make much of an impact. But if you talk about US where people are allocating assets, obviously 25 basis point increase can make a significant impact. People here expect 15 to 20% return from equities and 5 to 6% on fixed income. So there I think reasonable increase will be taken in stride.
Sure. So I wanted to know your currency, your view on the currency, because last year, if you see last calendar, we probably did about 17% on the Nifty, but if you look at the dollar returns, it was down 8%. So from a foreign investor perspective, that is the number that really matters. So going into this year, do you see a currency as an impediment from the foreign investor perspective? Do you see risks to that?
So last year, US increased interest rates by a historically high amount. Obviously, all the currencies globally weakened, and there was a lot of money flowing to US dollars. So that was an exceptional year. But even in that year, India has relatively done much better. So India's advantage is that there's a flow of investment money over, don't talk about 1 week, but over a period of time.
Yeah.
There's a flow of FDI money and there are good reserves. So at 575, $80 billion, India is fairly safe. So I think currency will do better than the peers. And compared to 2022, I think currency should stand much stronger this year.
Sure. So this is also a long pending thing with the finance ministry that, we wanted those tax tweaks on the debt side so that we're part of the, for us to become the part of the global bond index. Do you think that's a possibility in this budget?
I think they will work on this. I really don't know whether they'll do the budget or later, but I think they'll work on this.
Any attempts you think will be made to boost housing sector because ATC you think will get a makeover this time around?
By the government? So PMAY scheme was very good, which is Prime Minister Awas Yojana, where they were providing subvention through subsidy. I think this should be extended and continued. So for housing, I think that's the key thing. See, the tax incentives in housing don't make much of a difference to the affordable house buyer. So the subsidy scheme is a great scheme, which had been very efficiently done in the last few years. And that is something which government should continue to sustain.
How do you think the government spendings, we've spoken enough about the private capex, but how do you think the spending typically will be in the pre-election year? We've seen major thrust coming in from the capex expenditure side. You think this time around also the focus would be around that capital expenditure and we'll see that expense coming up and the defense probably going down? What's your assessment?
So in the election year, there will be a huge revenue expenditure increase as well.
Right.
And that's why I said disinvestment will become very critical for government to maintain deficit under control.
Right.
So there will be a thrust on both revenue and capex, which is direct payment to farmers, DBTs, and also the driving investment at the top end.
What do you think is the general sentiment today? I mean, on balance, would you think it's more positive or negative compared to the same time last year?
It's very positive, significantly positive than last year. People have overcome the recurring phobia of COVID. Last year, people weren't sure how the demand will pick up and what the growth will be, but now they've seen it. So the sentiment is a lot more positive.
Sure. So again, coming to domestic flows, one number that is a little disturbing is this discretionary investments in mutual funds. There are two parts to it, the SIP part and the discretionary part. And that number has gone down. And today there's also the latest numbers for SIP also shows some kind of moderation in SIPs. Have we really seen the full effect of a flat market or a volatile market? Has that investment psyche really played out in the markets, and do you think this can continue?
For sure. See, equity markets by nature are volatile, and the flow in equity market world over at any period of time you see has always been volatile. So by volatile we mean that in summers it will go down, in summers it will go up. So when it's going down, we should not be unduly disturbed. It's part of the nature of the beast.
Any themes that you'd like to focus on in this year?
No, there are lots of themes actually. So capital goods, engineering, agriculture, and infrastructure. So all these things, banks, financials, all things will do well.
But anything which is ranks at number one for you, and then according to the priority that you've named quite a few, right? According to the priority, can you put them in the bracket?
Very difficult to do that.
Maybe IT,
maybe construction capital goods will be a stronger contender.
Okay. Okay, so let's move on to the lighter segment in that case. I've got 10 questions for you and we get 30 seconds each and it's a rapid fire round, so we've got to be really quick. I'm sure you've been quick enough with all the answers. This is going to be no different. You started your career with HUL, worked with Ramdev for a little bit, the Motilal Oswal group, and then, of course, the chairman and the co-founder of IIFL. If not for this career choice, what was the alternative for you?
I would have been a teacher, maybe the professor, or would have been teaching in some college.
Okay. You're also an early stage investor in a lot of startup companies.
There's a corporate and capital market. So I might have continued with corporate. But as if neither corporate nor capital market, I would have been in academia.
Okay. Sure, because you have completed major chunk of your, education by 23, a lot of degrees that you hold. But moving on to the next question, early stage investor in almost 10 startup companies. What do you think about the new age companies right now? You think the valuations are lofty, something like a Mamaearth IPO valuation? Enough has been spoken about it, right? It's just profitable in FY22. What do you think about it?
Which about in general?
In general, and
Startups,
Mamaearth,
valuations are stretched, valuations are very high. A lot of capital is chasing companies and valuations have gone up, beyond the level where they'll give good return on the whole. So I think one has to be very selective.
All right. You think 2023 defensive will come back in vogue? If yes, which counters do you like? Just 2 or 3 picks that you like.
Stock specific, I won't go into.
Maybe name 1 or 2 for that matter.
No, but in terms of what kind of company you're talking about?
Maybe pharma or maybe IT for that matter. IT we have.
So IT Infosys is a good company.
Right.
And Auto Maruti is a good company.
Right.
FMCG HUL is a good company where I work. So these are all bellwether stocks in the sector and they're good stocks to own and hold for long term.
Sure. Also, I'm sure before every budget, a week or two, we see major rally coming in the railway, defense and agri stocks of thoughts, right? Anything there? Anything attractive?
So in defense EMS segment, there are many new companies coming to get listed. That looks interesting over medium term. There will see good growth.
Sure. Okay. One, everybody's got a mentor in life. I'm sure even you have. Any market guru or any mentor that you would like to name or you?
Mentor for market is difficult to say.
For you, market guru for you or mentor for you?
I learned so many things from so many people.
Sure.
So early in the stock market when I came, I started working with Motilal ji. So they learned a lot from him, Motilal, Ramdev, Rakesh Jhunjhunwala, Damani ji. So I interacted with all of them. I read lots of books. So there's a lot. It's very difficult for me to identify as one mentor because I never interacted consistently with one person.
Sure.
But there have been a lot of gurus in this market and they still are.
One inspirational quote that you keep in mind while managing most of the investors' wealth around or for the matter securities.
Quote.
Yes.
I think I really like this and Warren Buffett's quote. The stock market is a device where money is transferred from impatient investors to patient investors.
Right. What about your favorite book?
Favorite book?
Yeah. The one that you like reading.
Lots of books, and recently I'm reading one book which is by Rubenstein called How to Invest. So that's a good book. I mean, favorite book changes every year, but I mean, if you really want to do classics, then obviously, Benjamin Graham. So there are lots of books. So in every segment, there are different books that I like.
Sure. Any global or Indian CEO that you look up to?
Global or Indian CEO at this point in time?
That you like, yes.
I think, yeah. So these Satya Nadella and Sundar Pichai, both Indians, running global companies are the CEOs that really one can learn a lot from.
What's your stress buster? What do you like? How do you
take walk
stress?
actually.
Take walks.
Take a walk and spend time with family. Watch a movie.
So, what's your own take on the broking industry and where are we headed in terms of volumes and the structure of the industry? How do you see this realigning in terms of the platform companies, the new age broking companies, which have probably not seen profits but still are hopeful of making it big?
Interesting question too. So, broking industry volumes will go up and margins will come down. Technology will play an important role for sure. So, as it always happens, that some of the new age companies will survive and some of the new age companies will not survive. Those who survive will make a mark and be part of the top pecking order. Some of the old age companies will adapt to the technology and also grow. And some of them may not be able to. So the pecking order may change, but fundamentally the industry has already changed significantly. So from here on, I don't see much changes. I mean, the changes are continuing, they'll continue, but I think that structurally the industry has over last 20 years changed significantly. Consolidation, larger players, technology, compliance, all those things are already in place.
Sure. And what's your sense of,
Some of the new age players will have to learn and understand the compliance part of it, risk management part of it, because that is integral survival part of this industry.
specifically, what do you mean when you say compliance part of it?
See,
In
the
what sense?
regulators have become very stringent, and also a lot of regulations keep changing at a very rapid pace. So one has to keep pace with it and make sure that in letter as well as in spirit the compliance is done.
All right, with this, it's a wrap. Thank you so much for
Thank you so
joining
much.
us.
Thank you.
Thank you so much.